Hi guys, I just want to chat to you about a trend reversal pattern, which is some of you know it's one of my favorite things to look out for in trading and very, very powerful. Um, and yeah, basically it's the double tops and the double bottoms reversal pattern. So there's a few different ways that you can use them. Um, So yeah, what we do on the course is we go into your trends and your ABCs and your highs and your lows, lower highs, higher lows, etc., etc. And you'll find if we have a look at the screen now, we've got down the bottom, we could call this our A. Type it in there quickly. So A there. Then we've got our B. C. We've got our low, our high low, and then we've got our higher high. So obviously then A would be there, and then B would be here. And then we've got another C there. So what we expect is we expect the market to give us, we've got a higher low, we expect it to give us a higher high. And obviously it doesn't just go up, higher high, higher low, higher high, higher low, higher high forever and ever and ever. It's going to get to a point where the market reaches exhaustion. And what we get is what we call a double tops. And it's where we get another high, but the high is very similar level to the previous B. So that we call it a double tops. It's a sign that the market has reached the peak or reached exhaustion. And yes, so the bulls basically fail to break through. The bears are too strong, and they make the price go down again. So with this double top pattern, it's the sign when you see these two highs, which are roughly the same point, it's a sign that the market's going to reverse direction and go down. And the nice thing about it is it's actually what we call a measured move. And how we can utilize this is if we draw a line and join up the two highs. So in this example, they're quite horizontal, but sometimes it can either be slightly above or slightly below. So you might get a little bit of a slope. And then you measure the point from the kind of the V bit there, right up to the top of that line that I just drew. Quite a nice tool that I use. I like to use the rectangle tool to do this. So if we do that, we measure it right up there. Then the reason I like to do the rectangle tool is because then I can use it to help us to get a prediction of where the market is likely to go to. Because the rules of a double top say that if you measure from that distance to that distance, then the market should, once it breaks that horizontal level there, go the same distance again. So I guess you could use a vertical line or a trend line like I've just done there, or I just like to use the shape. And then what it will show you is a prediction for how far the market is likely to go. So yeah, it's a prediction of how far the market is likely to go. So basically we've got a horizontal line there, and once it breaks, and once you see a significant candlestick break through that, so you can see here we've got a couple of small candlesticks. Number one, you could say, okay, that closed below that horizontal level, but I mean it's barely broken that level. Okay, so I wouldn't consider that. I wouldn't consider the one after. But the next one shows me, okay, that has significantly closed now below this low here. So we've got a possible, well, we've got a confirmed double tops because it's only really confirmed once it has broken that level. So we've got a possible entry point there. So remember, in real life, we won't know what's coming. So I'm just going to put the bending as to, where to, basically where I would have entered the trade. Square. Let's just do the square again. Okay, all right, so we've got the rectangle that going down like that, and we've got our predicted move there. So we're going to put our blue line, which is our take profit there. And the question is, where are we going to put our stop loss? So the kind of the logical point would be to, or the safest point would to be put it above these two highs here. But the problem with that is that it doesn't give us a very big risk to reward ratio. You can see if that's 1% risk, and that's going to be about a 0.5% reward. So we would then consider maybe doing it halfway down. Again, it just gives us a one-to-one risk to reward. The other thing that we can do is we can consider looking for an earlier entry. So instead of waiting till the break of that line there, what we can do is we can try and get into that trade a little bit early. And instead of waiting to go to pass the neckline there, then we can consider entering on that second high. So how will we do that? So the first thing we would want to do is we want to spot two highs, which are about the same. And we're also going to look at the stochastic. So you'll notice that whenever, normally speaking, okay, we're in an uptrend here. So whenever we get the stochastic that goes into the overbought section, get a high, and then when it next goes into the overbought section, see the candlesticks have slightly gone up. And then the next time it goes in, then the candlesticks are higher. Now, when you see that the stochastic goes into the overbought section, and you can see the highs are at the same point, then we can start considering this might be a double tops. So we would want to go up to a higher time frame just to confirm, is there any other technical barriers where we're expecting to see a price reversal, whether it's likely to bounce off of. So if we went up, for example, on this occasion to the weekly, and we saw there was a nice big horizontal weekly level there, then it would make sense that the daily market is going to struggle to break through that level. So we could then speculate that it's going to be a double tops. And when you see the stochastic then go back down through the 80 line, then at that point there, we could look to actually enter the trade. The other thing that I would want to see is I would want to look at my MACD and just to look out to make sure that the peaks of the MACD are also dropping. Okay, so you can see we've almost got, it's not really divergence because it's equal peaks, but if it was a slightly higher high on the right-hand peak, then that would indicate divergence. So I want to see the MACD with the second peak looking lower than the first peak. And then I would want to see the stochastic pop down through there, obviously on the lookout for any candlesticks or Bollinger Bands or anything like that to add in our favor. But if you got all that and it was a point where you're expecting a trend reversal or looking out for a trend reversal because of Fibonacci levels on a higher time frame or trend lines or support and resistance, then you could enter a trade at the close of this candlestick here, based on the stochastic there, based on the divergence, based on the double tops pattern. So at the close of that candlestick, you could have entered a trade. Where are you going to put your stop loss? Obviously, you're going to put it somewhere above these two peaks. Where are you going to put your take profit? Again, it's a measured move, so we measure from the top down to there. And then we predict it's going to go down. Sorry guys, it's getting a bit messy, I know. Predict it's going to go down. Okay, so you can see now we've got a much bigger risk to reward ratio. And if you actually entered at that point, and if that's our one, then you're probably going to make 3.5% to 4% on that trade. So it's just a way to get a better risk to reward ratio from a double tops. You obviously need to gather as much probability. So again, you want to go up to the higher time frames and just have a look just to make sure, is it bouncing off any big level? You want to make sure you've got the divergence, or at least the MACD, sloping down at the same points. You want to make sure your stochastic goes into the overbought section and then crosses back down, and the candlestick closes. Candlestick closes as well. So on the close of that candlestick, then you'll have that new part of your stochastic going up and down, but this bit is fixed. So at that point, if you wanted to, you could place the trades, and again, you just get a much better risk to reward. The downside is that you're probably not going to be right as many times, but is it worth it? In my opinion, yes, because when you are right, you're going to make a lot more money. So guys, I hope that helps you. Obviously with the double bottoms, it's exactly the same, opposite way around. I'm not going to go into detail and give you another example on that. Hopefully you guys understand. If there's anything you need clarification on, then just give me a shout. Thanks. See you next time.